Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. This is a weekend update. This is for October 27, 2018. You're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Obviously, the $64,000 question is, did we bottom? Is this a bottom in the market? And just to cut right to the chase, I don't believe so. We're going to get into all the reasons why. I'm also going to discuss where I think the market's going to bottom, but more importantly, when I think that's going to happen. As you'll know, I believe time is more important than price. We're going to discuss that in detail tonight. Before we get knee-deep in all the technical attributes and details on the charts, let me first thank everybody for participating, making comments and posts underneath the video. They're important to the entire community. Please keep up the great work. It's helpful. Your comments are well received. In addition, please hit the like button on the video and share the video with anybody that you think can benefit from this information. So here we are in the SPY. We're down in the zone that we discussed a long time ago. We've already satisfied the 265.37 number. That was done. Now we've come down close to the 261.73. We didn't quite get there on Friday. We came close. The low of the day happened to be 262.29. I don't think this is a bottom any way you want to look at it, either way. We did have an increase in volume, but it's not enough volume. We really need to see, in my opinion, 250, maybe even north of 300 million shares traded in the Spider in order to put in a significant low. But we're getting close. Over the last couple of days, we discussed the fact that does it really matter at this point where the market bottoms? Does it really matter whether it's 263, 261, or 258? It really doesn't matter because all that's going to be done, at least in my estimation, based on my work, in a very short and rapid period of time. But we need more panic. We need more fear running through the markets. We just don't have maximum fear in order to put in a bottom yet. We will. Something will take place over the next several trading days that will trigger another leg down in the market, which will be, in my estimation, the capitulation low. We'll see a reversal. And if I'm right and the market does take off to the upside in a very short period of time, it's going to cover a very large swath of points. From wherever the bottom is made, you'll likely see about 150 S&P points or more in about a week's time. But let's get specific. Where am I going with this? What am I looking at in terms of price and time? First, we'll cover price. So let's look at the weekly chart. Where do we think the market is going to find a legitimate and solid level of support? At this point in time, you have to look toward the 100 period moving average. Comes in right now at 257. I don't think that's going to be it. I think that could be a potential fake out level if we're going to get a real trapdoor opening to the downside to scare people enough, which is what actually creates the bottoming process. But in this case, what we're looking for is a culmination of the process. We're looking for a final exhaustion leg down. I think we could see the market trade all the way to 250, maybe even 247 down in this area. I'm not necessarily suggesting it has to happen. In fact, my minimum downside target has already been achieved. But what I'm suggesting right now is the market is stretched and we're going to get a capitulation day or two or even three into next week unless we get a quick repair job overnight at the futures open up Sunday. If we get a repair job and the market opens up higher and can scream higher Monday and do some repair from the damage, that'll be a different story. But this is in the event that we actually continue lower into this coming week. So continuing lower Sunday night into Monday or just into Monday, then we have to start looking down at minimum to the 100 period moving average, potentially down to 250, maybe even 248, 247. But that's on a real opening of the trapdoor, flush market lower. So that's price. What about time? Why am I looking at time? We've discussed over the long period of time why time is more important than price. If you're new here, you may not agree, and even if you've been here for a while, you may not agree, and that's okay. That's what makes a market. Two people, two traders, two analysts, two people can look at the same stock, the same chart, the same market, whatever it is, and see two entirely different likely outcomes. That's what makes a market. That's what's fascinating about markets. But in any event, I go with time is more important than price. And as an example, when time is up, time is up. And I use a triangle as an example of that. Sometimes the market will begin trading in a format that creates a triangle. So for example, if the market ends up doing something like this, it's creating a triangle day after day or hour after hour, or it could be any time frame on the chart. And what happens is, as these days continue to get narrower and narrower, what the market is doing is creating a triangle pattern. And generally speaking, at the end of a triangle pattern, once the market gets to the peak of the triangle, the apex, it's going to either break up or break down one way or the other. Some of it has to do of where the market was before it began making the triangle, what the likely breakout or breakdown scenario would be. But the point is, when the market gets to the apex of the triangle, time is up and it has to break one way or the other. That's an example of why time is more important than price. It's an example, but the point is, and I use a lot of different techniques to come up with what I think will be the culmination of the current downtrend. I think it's going to happen midweek. We're going to say Wednesday. I've got to have a day on either side. So Wednesday's my day. Could it be Tuesday? Sure. Could it be Thursday? Sure. But I think Wednesday is the pinpoint bottom in terms of time. We'll see if I'm right. I don't have to be right. This is what my work is telling me. And here's the deal, folks. If you've taken my course at Lazy E-mini Trader, you should be able to see why I believe Wednesday is our spot. There's two reasons that you should be able to identify on this chart, and there's actually three reasons that support why Wednesday is the day. Now think about that for a second. If you haven't taken the course, then you likely don't have a full and complete understanding of what I just discussed. However, would you like to be able to identify likely points in time when markets will turn, even on an intraday basis, all the way out to a daily or weekly basis? Traders who take the course, not only do they learn why time is more important than price, but they also learn how to use it to their advantage in their trading. Another question comes up: are you still buying into the market on the long side in some stocks where you see opportunity? And the answer is directly yes. Nothing has changed. However, what I do want to note is I did take significant amount of time to keep CNBC on in the background on Friday. I wanted to hear how bearish they were getting. That's important. That's an indicator. Just like the more bullish they get, the closer we are to a top. The more bearish they get, the closer we are to a bottom. I can tell you they were very, very bearish. They're starting to get concerned. We're starting to hear recession discussions. We're starting to hear the Fed is to blame. We're hearing all kinds of things. They're in search of the reason why. Each and every day, it tends to be something a little bit different. But one thing I can assure you of, when the market turns, whenever it turns, it will turn for a headline reason. Doesn't make any difference what that headline is, but it will be a headline reason, and everybody will forget about the reason why the market was supposedly down. Well, it's not supposedly down, it is down, but the supposed reason why, and they'll focus on the recovery. They'll call it a correction. It will have been down 10 or 12 or 13 or 14%, whatever it's going to be at the end of the time. They'll say it was a correction, it was healthy, and now we're going to go on and continue the bull market and make higher highs. That will be the discussion coming out of the bottom. Now, we're going to take a look at an intraday 10-minute chart. And here's why. because I recognize that the market seems crazy and wacky and extremely difficult to participate in. I understand that. But the reason why I bring this chart up is because I also want to display that regardless of the increase in volatility, nothing has changed. The market is trading extremely technically sound. And I want to prove the point that it is trading technically sound. And here's how I'll do it. So traders that have taken the course will know exactly what I'm looking at. Here's a low and here's a high. Okay? So what you'll notice is that there's another high right here. So traders that have taken the course understand that this is an important pivot top and this is an important pivot bottom. And this is an important retracement. That's item number one. Item number two is from the pivot bottom, the market took a specific period of time to get to a specific price level and reverse. So here's where I'm going with that. Right here, there was a very, very high probability trade with a very tight stop or small risk of being wrong. So that was a short trade. That was a layup if you were following the rules. But wait, there's more. There's another trade right here. And I know it seems like an after the fact type of thing, two perfect areas. You can't possibly nail it like that each and every time. But what I am telling you is if you go to the course and you follow the rules laid out in the course, these are two trades that slapped you in the face. They're low risk, high reward trades. The market is still trading very technically sound. I recognize it's hard to see and do in real time when the market is as crazy as it's been, but even after the craziness, when you look at the chart after the fact and you analyze it, you say, look, it did exactly what it was supposed to do when it was supposed to do it. It's hard to argue. Shifting gears a little bit, we have the IWM. Now, the IWM is really, really down hard. Is this a bottom? Is this a pseudo doji candle in the IWM? It's possible, but if I'm right and we're still going to get another trapdoor opening and a capitulation low, if that's the case, then the IWM is going to follow suit. That's just the way it is. Is there a clue out there that we may be trying to make a turn? Well, sure. The IWM was only down 0.75%. The spider, as a comparison, the S&P 500 was down about 1.2%. Is the IWM trying to tell us anything? As crazy and as volatile as the markets have been over the last several days, we're going to have to take that with a grain of salt. We'll note it. It's a small puzzle piece. It's on the table, but we're not going to give it too much weight right now. Now remember, there's always a flip side to the story. I'm saying that I believe Wednesday's a turn at lower prices. Understand that if we wake up Monday morning and the market's higher and we gap open and keep going, then we're going to know where important hourly closes are, and my traders will know that Monday morning right out of the gate. These are traders that get my morning notes and the S&P E-mini futures contract support and resistance levels. Since it is the weekend, we can take a look at the longer term chart and you can see it's been quite a breakdown here in the IWM. I'll have to say it's a fall from grace. We wiped out a year of gain in a few days. I should really say a few weeks. Really, the majority of the gains were wiped out in about 4 weeks. Escalator up, elevator down, every time. What's going on over at the VIX? I think it's interesting. So here's the weekly chart, right? It's a pretty clean weekly chart. Looks like a bullish pattern, and it looks like it wants to go higher. So we can't necessarily discount higher prices coming into this week. Higher prices in the VIX would mean lower prices in the stock market. We'll see if that's what pans out. I do find it interesting, and it certainly is a puzzle piece, that we haven't made higher highs in the VIX, and I'm talking about the recent highs. So when we go back to the daily chart, you can see what I'm discussing here is the highs that were made on the 11th of October. We've not yet surpassed those highs, yet we've made lower prices in stocks. Is that indicative of a market that's trying to formulate a bottom? Generally speaking, yes, but we certainly can't discount a capitulation trapdoor opening in stocks and a spike higher in the VIX. It's not off the table. By the way, on the flip side to the market, let's say we do wake up Monday to a higher opening. What's that line in the sand that we'll likely be looking at Monday morning to determine if there's really a bull case or is the market going to fail again? And what I'll tell you is, I'll give you my numbers for the S&P E-mini futures contract, and it would have to be hourly closes up into the 2690s area. 2693, 94, 95, in that neighborhood would begin to take some of the trapdoor scenario on the downside off the table. Hourly closes up there likely bring the market back to 2700. Hourly closes there bring the market a little bit higher, and they begin to do a repair job. So I'm trying to give you both sides depending on what we wake up to Monday morning. Frankly, I would like to see this done already. I would like to see a gap down and a reversal. I think it's going to happen Wednesday. I don't care when it happens, frankly. I'm long the market. I'm going to get much longer the market in the coming days. That's not anything that anybody should take as advice. I'm telling you what I'm doing. I certainly don't know anybody's individual situation, so nobody should do anything based on what I'm doing. You should do something based on what you want to do and what's appropriate for your situation. Transports. Have we found bottom yet in the transports? No, that's not what a bottom looks like. We were down another 126 points on Friday in the transports, another 1.25%. It's just not a bottom yet. We don't need these lines. There's a lot of lines around some of the charts that we don't need any longer. We'll get rid of them as time goes on. But let's go to the weekly chart. Just reiterate where we're likely headed. If there's a flush lower, there's two spots. And it really doesn't matter, which one ends up being the low. But the first one is right here around 9,500. That doesn't hold. They're going to run for the 200 period moving average down here around 9,000. And that's going to be your spot. And that's where you're likely going to get a reversal. If it's the other side and they do a snapback, they're going to immediately make a run for the 100 period moving average and try and trade away from that, north of that, as quickly as possible. So that number right now comes in at about 10,029. And when you go over to a daily chart, just to give you a visual of what that looks like, it just so happens that you would be beginning to challenge the top of the last breakdown candle, right in this general zone right here. So maybe it goes slightly higher, but that's where the first level of resistance would likely be. Funny how that works out, isn't it? A moving average on one time frame happens to be an important level for a different reason on another time frame. Maybe some of you start to scratch your head and say, hey, maybe there is something underneath the hood of this stuff. The Qs have been getting punished because Amazon and Google and others have been getting punished. So you can see here we had that tremendous breakdown candle here. Then we had an up day, and look where we are now. We made lower lows on Friday, but we closed above the previous low. So that's at least something of a positive, but it's not a positive chart. They're going lower under normal conditions. This is not a bottom. This is not how bottoms are made. Interesting how they're pretty much 11 cents away from a number that we identified a long time ago. 166.55. We closed Friday at 166.66. Interesting number one. And number two, that's not an accident or a coincidence. You see the lower number, 158.80. Down in that area, there's a gap. If we have a flush lower, they're going to run for that gap in the Qs. Whether or not they get there, it's pretty far away. We'll see. But on a real hard sell in the market, they can certainly do that. That would be panic selling. That would be capitulation selling. That's margin selling. That's force selling. That's what we want to see in order to form a bottom. The XLF, tremendous fall from 29 and change. We've talked about this so many times. I'm blue in the face from it, and so are you. Is that a bottom yet? Probably not. I mean, it could be. I could certainly make the case it's a bottom. Look where we came to. We talked about 25 the other day. We made a low. You have to see this. Let me move it over. Here's the low, 25.02. Bounced off that level. We talked about 25. Couple of days before it happened, we were all the way up here at about 26.5 at that time. 25 was obvious. It doesn't have to be obvious to you today, but if you take the course at Lazy E-mini Trader, it becomes obvious. SMH, could you make a case they're trying to put in a bottom? You can make a case. Does the volume support the bottom? Not even close. So I'm not buying the bottom story. Look at the weekly chart. That's the spot. $86. That's where I think they're going in the SMH. I think it's a buy down at 86. I'll be interested to participate, but certainly make the decision in real time at 86, 86.5. Looking at some of the fan favorites, we'll start with Amazon. Interesting to look at this chart, right? We have a candle like here, and that's a sign or a signal of a trend change. It's one of many. And then the market rallies for a few days, and then we fail. We get stopped at the 200-day moving average, and the market rallies again, and we fail, puts in the same kind of candle right underneath the 200-period moving average. You can see some horizontal trend lines down here below price on the chart. You can jot those down. Those are logical, at least from my work, areas of support that I would be interested to participate in Amazon from a day trading perspective. But again, you have to see the chart and you have to see what's going on in real time. I'm not saying that I'm 100% sure on Saturday that 1580 is going to be a good level on Monday. But on Monday, if price comes into 1580 somehow, some way, and I have supporting reasons why I want to take that trade at that time, that's one thing. I have to make the decision in real time. Here's a chart of Apple. So to the naked eye, anybody that's taken the course would say, yeah, this is a bearish pattern. It's underneath the 20 and the 50 period moving average, which are all of a sudden sloping down. But we had an increase in volume, and the candle is interesting. What's going on in Apple? It's interesting. The chart is saying it wants to go lower, but at the same time, I can make a case it's trying to put in some kind of a low. So I have conflicting information on the chart of Apple. So when that happens, I don't do anything with it. I can't be long, I can't be short because I have the conflicting information. There are times when a chart is just not crystal clear. If that's the case, and it happens all the time, you don't do anything with it. Right now, I wouldn't necessarily do anything with Apple. I would be interested at lower prices to be long Apple, but I wouldn't be interested here to be long Apple until it told me something else. It needs to be providing better information on the chart to me. I just don't see it. Facebook, again, it looks like a lot of the other charts. It's trying to indicate a sign or a signal of a trend change. I'm not 100% convinced. We're seeing that on a lot of charts. I don't know if those are meaningful or not at this juncture. We're going to take it with a grain of salt. I see them. It doesn't matter when the market makes a turn to me. That's why I'm not paying too much attention. I'm looking for a turn. I think a turn is coming, but I don't care whether it comes Monday, Wednesday, or Friday. It really doesn't matter. But it has to come. That does matter. But Facebook is a broken chart. When you go over to the weekly chart of Facebook, and there's another one for you. I'm giving away all my numbers in this video. 141 is an area that I'll be looking at Facebook if it gets there from an intraday perspective. There could be other numbers before that, but I've done some work on Facebook and I've identified 141 as an area I would be interested from a day trading perspective. There certainly are lower numbers. There may be higher numbers, but 141 is a number that I certainly am interested in and have an alert set as a result. Now, keep in mind, this is a broken stock. Symmetry says, and this is a long-term chart. This is a weekly chart, so it could take some time. But Symmetry tells me that this really wants to get down to $130, maybe even down to $1.25. I actually heard an analyst, a technical analyst yesterday, because I was watching some CNBC. I actually heard a technical analyst say that he believes Facebook will never ever see those highs again. And I actually agree with that particular analyst. This chart indicates significant underlying issues for Facebook. It'll be at higher numbers at some point over the next several months, certainly make an attempt to rally back to 160 or 175. That's certainly possible. In fact, it's more probable. But this is certainly a broken chart. Let's take a look over at Netflix. I want to go to the daily chart. We're stuck on the weekly from Facebook. So here's the daily chart. And again, we're seeing another one of those candles. Now you see my numbers again. I'm giving away all my secrets. The top number was 288.94. We didn't get there on Friday. We came close. I would have bought that number. I was locked and loaded at that number. The low was 292.30. I was slightly lower. That's the number I was willing to buy. This brings up an interesting topic. I'm not going to spend a ton of time on it, but it's certainly worth addressing. As a trader, as an investor, you have to be picky. You have to be mechanical. I'm only willing to buy stuff at my numbers. I miss trades all the time because I don't get filled at my number. And traders will ask me, well, if you're willing to buy it at $28, then why wouldn't you be willing to buy it at $28.05 if you think it's going to go up from there? And the answer is, I understand the question. That's not really what's going on here. I'm not missing out on gains for the sake of 3 or 4 or 5 cents. That's not what's going on. What's really going on is a discipline. It's not about the 5 cents, and it's not about the $2 or $3 in Netflix. It's about the discipline of following a set of rules. And here's the reason I bring it up, is I've already done an analysis on a couple of trades that I lost on this month in October. And you should do that too. Everybody should analyze not only their winning trades, but more importantly, their losing trades. What did you do right? What did you do wrong? What you did wrong, you don't want to repeat, and you want to understand. And I said analyze our winning trades, and that's, by the way, by design. You want to analyze your winning trades because you want to make sure that you didn't make a mistake and win by accident. Why is that? Because you can do the same thing unwittingly or unknowingly later on in another trade, and you can lose thinking you were in for the right reason. So you always want to analyze both trades, the winners and the losers. Double check that you're doing everything correct, following the rules. But that's the point. It's about a discipline. If you follow the rules, you'll be successful. There were 2 trades in October where I broke my own rules, and guess what? They were losing trades. And I look at myself in the mirror and I say, you've got to be kidding me. I teach traders the rules. I teach them not to break the rules. I tell them why, because when you break the rules, you lose. And then I break my own rules and lose. And guess what, folks? I'm human. I'm not perfect. I broke my own rules and I paid for it. Guess what? I taught myself another lesson. That's not the first time, but I hope it's the last time. Why do I have a chart of General Motors on the screen? Because it was up 2.5% or 85 cents on a day when everything else was down. That's relative strength. GM is telling you something. Now, you certainly don't ever want to chase a stock, but looking for a buying opportunity is feasible in GM. Here's an hourly chart, and you can see what it's doing. It looks to be building a bull flag pattern. So the risk with a bull flag pattern is we can come all the way down to the moving averages down here and still technically be in a bullish pattern. So it's hard to buy a bull flag pattern, but nevertheless, the chart today is telling us more upside is coming GM's way. Just like everything else. These don't work out 100% of the time, but if you know what you're looking for, the strategies and techniques that I teach work out the majority of the time. When the market is getting killed like it was the past several days, I'm looking for areas where there's relative strength, because when the market turns, where there's relative strength while the market's going down, there will likely be relative strength while the market's going up, and you can see a slingshot effect on some stocks that show relative strength in the downtrend. Just food for thought. We have to jump over and talk about gold, and in gold, the same thing continues to be the case. We're edging our way higher as the market's edging its way lower, meaning the stock market. So there seems to be, at least currently, that inverse relationship of the fear trade. So the market goes down and the fear trade is on where gold goes higher. But frankly, it's not going a whole lot higher. So what's that telling you? If the market was going a whole lot lower, Don't you think gold would have went a lot higher by now? I would have thought we would have had a couple of big up days, $20 and $30 days posted in gold, and that hasn't really happened to a large extent other than here and there. So I'm not sure whether there's a lot of upside past 1250 in the gold complex. Crude oil? What's going on with crude oil? It's putting in a bearish pattern over the 200-period moving average. Hard to be short in the hole. It's down a lot. But could you get short at the top end of the last breakdown candle? Most likely you could. You have some overhead resistance with the 50-period moving average above that as well. Fat, juicy, round number of 70. There's a lot of reasons why there would normally be overhead resistance around 70, but I couldn't be short before 70, and I couldn't be long to get to 70, so there's nothing I can do with crude oil right here, right now, from a swing trading perspective. And with that, folks, I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.